Hey, good day, everybody. I'm so sorry for getting started a little bit late. We ended up having a little technical difficulty on our end to get launched this morning. Anyway, good to see everybody on. My name is Rob, and we're going to be spending the next hour or so going over a few different things for those of you who are new. By the way, would somebody give me a Y in the chat box just to let me know that you can hear me? We'll be doing a sound check. Very good. Thank you so much. So anyway, the agenda, we're going to go through the volatility report. Shane will lead us through that. And then he's also going to do a little bit of training as well. So we look forward to that. And then Wade will follow him behind that. And both of them will kind of tag team. So that leads me to the next thing. For those of you that are new, if you'd like to have a currency pair looked at, we want to make sure that you give us the currency pair, obviously. And then we also, what we need is we need your entry time frame and then your directional bias time frame so that we can do kind of a top-down analysis of that for you. And if, by the way, we don't get to your question in the chat, you can always send it over to support@tradeats.com. So be sure to take advantage of that. Support@tradeats.com. You can send their screenshots of your trades and get an analysis done there as well. So with that being said, I also want to remind one other thing. For those of you that are new, if you have a technical question about the indicators or loading things up or something in the classroom, we don't want to try to handle that in this webinar. We'd like to just send those to support@TradeATS, those questions, and we can help you individually with those. So again, what we're going to do is we'll be kicking off here with Shane, the volatility report. He's going to be doing some trading or training, and then Wade will step in behind that. So Shane, why don't you go ahead and take it away? Tell us about the volatility report.
All right, thank you. So as you mentioned, we're going to be going through the volatility report. I'm not going to spend a ton of time on this one. The first pair that we've got featured on it is dollar CAD and Aussie versus the franc. So we'll go ahead and jump into Aussie franc real quick. Actually, neither of these has really taken off yet, which is a little bit of a bummer, but Aussie franc I would say is probably closer than dollar CAD. In the volatility report, it talks about basically how this is the highest box inside of this daily range. And we're getting a little bit of a reaction off of the expansion line. So the theory behind this, this general setup is that since it's the highest box in the range, we had a master pattern and we had an expand high, that there's a really high probability that price will go rotate off of the expansion line at the high and then start heading down short. So just to bring it back to the chart, we can see that that's playing out a little bit. We popped up through the expansion line and we'll see if it rolls over short. So as far as actually trading this, getting in somewhere around this general level, if you wanted to test an entry to the short side, would be how to handle this situation. Obviously, if it keeps, whipping back and forth around the expansion line and starts taking off long, we want to change that bias, but it's just a trading idea that seems like it has a high likelihood of working out. All right, so let's go ahead and jump over to dollar CAD for just a moment. There we go. The volatility report from last week, that one worked out really well. I think it was pound Aussie and pound versus the dollar. Both of those just cratered over short, and that was kind of the bias that we were looking at happening. But these just haven't really played out quite yet, so we got to give them a little bit more time. As I mentioned, dollar CAD just kind of setting here, hasn't really done a whole lot so far. We still don't really know if this one is going to go in favor. I had a short directional bias on this because we've got plenty of liquidity down here, and we came back, gave it a little bit of a breath, and we'll see if we get a reaction off of this expansion line and continue down short, or maybe we'll get a bounce off of it. But either way, we are still expecting this pair to move around pretty decently. All right, so Now, for the training that I wanted to go through with everyone, there were some good examples that came up on the on gold versus the dollar. So I was hoping that we could go through a training just again of the master pattern and the origination points. Before I get into this, last time we had a few issues with everyone being able to see my screen and everything. Just want to double check. Is everyone seeing my screen all right and having any lag or any problems with that? All right, it looks like we are good to go. All right, beautiful. So what I was hoping to cover here is, and then this training is going to be added into the training that we had in the classroom. So that video is very soon going to be coming out, but this is going to be formal training, and then we're going to cut and paste this together with a little bit more recorded segments. So what we're planning on going through with this is one, identifying origination points. So how to do that. And then two, finding a strong entry with those origination points. Namely, something I like to, there's a really great example, wicks against trend. So that evil wick where you're in a trending market and that wick comes down and, you know, snaps you out. So how to handle those, which this will help you with. And then three, how this fits in with the basic strategy. So we're going to be covering those three things, and then we'll kind of wrap it up with any questions that you guys might have about this. Okay, so the first subject is identifying origination points. So this is a very simple thing and just really want to drill down on it. The actual criteria for identifying an origination point for the master pattern, which the master pattern, just to reiterate what that is, the master pattern is when price breaks out of an expansion and it expands low or high and then back and forth, and it's the whipsaw out of an expansion range leading up into the trending phase. We can see it's happened, you know, we're still in the midst of this one up here on the 4-hour, but we can see it happen right here. Broke out high, so expand high, expand low, expand high, then it comes back, and then price settles, and then it goes into a trending market. So it's how to deal with that and how to identify it. We're mostly going to be focusing on the entry time frame as well. So anyways, that's what the master pattern is. Now, how do I identify an actual master pattern starting to take shape? Very, very simple. When you form a new box and price breaks through the low or the high of it, through the low, through the high, that is a potential master pattern right there. And then it gets a little bit different if you're in a trending market, because at that point it could continue pushing. But if you have a expand low, expand high, and then expand low once more, like we see here, then that is the beginning of a master pattern. And you'll find that usually right at the end of a trending move. So that's how you identify master pattern. Let's look for a few more just to make sure that this is well understood. So we've got one right here, expand low, expand high, and then we never formed a box, and then we had our expand low. So that's one other thing. If you have an expand low and an expand high before a box is, and a box is formed before the high and low is taken out, then that would not be considered a master pattern origination point. Let me take a look at that real quick and see if I can't find an example. Okay, this is one. This is a bit of an odd example, but we had an expand high and then expand low. So through the high of the box, through the low of the box, but we formed another box inside of that cycle. So that would not be considered a master pattern origination point. So take that and you can apply it to your smaller time frames as well. Let's see if we have another example of that, because that's probably one of the aspects that can get a little bit confusing. Happens pretty frequently inside of small ranges. Yeah, this would have been this would not have been an origination point right here. So we had an expand high, we almost had the expand low, but then we formed a new box, and then we had the expand low out of this box. So this would not be the origination point. Now, what that actually changes is just where you draw the origination point from and what you use as your low. So let me explain what that means. The origination point is where you're going to find very often that the market goes back, tests, and then the trend takes off from. So let me go back to that last example right here on the 4-hour. So we formed a master pattern origination point. We had an expand high, expand low, expand high, and then it came back and price rotated or settled on the origination point before going into trend. If you correctly identify where the origination point is, then you'll find it's a little bit easier to see when price actually does settle. So right here we had our origination point actually form right here. So this would also not be an origination point. We had 2 boxes form after this price broke out to the short side. So we had expand high, expand low. It expanded a little bit further down. I don't know if any of you remember the lesson from last week, but we were talking about boxes at the lowest part of the range, that those are a little bit more reactive. That would be an example of that happening right here, where price rotates off of the lowest box inside of a range that it forms, and then that ends up being the entry. So anyways, this back to the origination points, this would have been the official origination point inside of this range. And we can see that price came back and it went a little bit through, but right after pushed up long, came back, retested it, and then took off in trend. So the form that it takes can be a little bit different from time to time, but overall you'll see the same thing play out over and over and over again. We had another one play out right here, expand high, expand low, price pushes down, comes back, tests the origination point, and then starts pushing from there. All right, so one thing that I wanted to go through is finding how you can use this to find a strong entry. One of the common things that happens with the basic strategy is it can be a little bit broad in that all your the main criteria of it is you're above your most recent expansion line on your directional time frame and below your entry below your most recent expansion line on your entry time frame. So you want them to be opposite, and the idea is that you'll get into a counter trend pullback and then it'll fall back in line with the actual trend and opposite for a short market. So one thing that I wanted to highlight, but we all know that, it's a little bit difficult to figure out exactly where those pullbacks are going to go. So a good example that I found that was just real close, happened not too long ago, was this example that we've got right here on the 4-hour chart. So we can see at this point, we saw that we were in a market that was pushing up. We had a little bit of a range that formed right here out of the 4-hour, and then price started pushing up, and you wanted to test an entry going long at this point. Now things ended up developing a little bit differently through here and ended up reversing, but just inside of a regular trending market, and you want to try and find your way into this. We all know that wick that came down right there, those are really difficult to deal with in the moment. So this is where the master pattern can help you on dealing with that wick and getting in a solid entry at the lower side of the wick. So let me go over and find this. Okay. So this whole area up at the top is this range right here on the 5-minute. And you can do this on any time frame, by the way. So it's not restricted to the 5-minute. So let's look at what happened up until this point. Price was pushing up. We had a little range through here. Looks like that might have been in some market off hours, but then price started taking off. We went and took out some liquidity on the 5-minute, and then we formed a master pattern origination point. Now, inside of a trending market, when you form a master pattern origination point, you don't necessarily know that it's not just a breath inside of the trend, but when it comes back, maybe pushes a little bit and you get the third leg of expansion. So this would be expand low, expand high, and then we get expand low. we know that one, this is our origination point right here, and two, that we can probably expect a range and some little bit, it's not going to be just straight trending market anymore from this point. So how do we deal with this? So as we know, the market, once you form an origination point and the master pattern happens, then you start getting the whipsaw effect where it'll expand high, expand low, expand high, and then go into the trend. Now this ended up being the turn, but we didn't know that was the turn at this point. You still want to test a long entry. So the way that this can help you with the basic strategy is we got an expansion line right here. We're in, as of this point, we know that we're in a trending market. The market is headed long, and you know that you're supposed to get in below an expansion line on your entry time frame. So as the whipsaw happens, you can expect every expand low or expand high will eventually turn into a new target. So what I mean by that is after the market expands to the high side, that's now the new target of an expand low or of an expand high. So we have expand low, expand high, expand low, and then that became the target for an expand high, and then the price ended up reversing right there. But that was our target from way down here. So once that low gets taken out, that would be where you get your basic strategy trade, the ideal basic strategy trade. So you're underneath expansion and you're looking for price to come down and take out the expand low point, and then you're looking for an entry after that happens. Sometimes it can get a little bit tricky like it did right here where it pushes up and then we get another small master pattern that whips through and takes out a little bit more liquidity. But either way, this general area would have been better than seeing this expansion line and trying to take a trade right here. That's what we're really trying to avoid, is when we're in an expand low, taking it, we're looking for a general area to go and enter the market. So that's kind of where this can help you. All right, let me look for a few more examples just to make sure that this is clear. There's actually a few good ones on the Dow. I'm going to go ahead and jump over into that real quick. Okay, right here. This is a good example. So right here, we've got a fairly clear uptrend inside of the Dow. So price broke out. We actually kind of that lowest box of the range, and then we started pushing up long from there. So on the 5-minute, on your actual entry time frame, we did not get a master pattern. We were down in this small range that was caused by the expansion line, pushing up, and now we come up near the high, near the current range that it's in, and we get a master pattern. Whenever you get a master pattern after a big push, again, once you start getting the expand low, expand high, or expand high, expand low, expand high, you know that there's very likely a range that's going to start right around that area. And that's pretty much exactly what happened right here. So expand high, expand low. So once you have the expand high and expand low point, those become targets. So this expand high point, once price took that out, then we had our expand low point that was right here, and that became the target for the expansion to the low side. So if you're trying to, just to reiterate what we were saying again, if you're still trying to trade in a long market, then you want to enter your trade after that expand low has been taken out. And if you are trying to trade in the opposite direction and you think that maybe this could be a good time to possibly try a short trade, you saw the liquidity get taken out on the 4-hour and you just want to see if if there's going to be a turn, then at least get a strong entry into that. Once we had price take out the expand high point right here and went through the liquidity, then you try a trade up in this neighborhood because we just took out the expand high point. You don't necessarily know that it's going to trade, but that would be a strong entry to test your theory. So again, going back to this expand high, expand low, we can see we formed a box at the high side of the range and then price rolled off of it to the short side. So we had expand low. Keep in mind, this was the origination point inside of this range. So this was our very first master pattern origination point. We can see what happened right there. Origination point, expand low, and then price settles off of it and keeps pushing down lower. And now it looks like we're forming a new origination point, so we're gonna have to kind of adjust. This is also the lowest box inside of this range, so we'll have to see if we get a rotation off of it going back up into the long side. So just a few points I want to touch on. You don't necessarily know exactly which expand high or expand low is going to be the one that takes off. There's not really a great way to know. Sometimes it'll be a 1, 2, 3, and then 4. Sometimes it will be 1, 2, 3, and it'll keep on going. That normally happens while it's inside of a trending market, and it's not quite stopping yet. So you don't really know exactly which expansion leg is going to be the one that turns into the big pushing market. But what's important is that you test them and that they help you get into a strong entry. Because if you got in, you know, somewhere around this expand high point, maybe you weren't really messing with this, and then you saw that wicks were starting to rotate off of this, and then you got in somewhere, you know, even bad entry into this candle, and then it snaps down, it's pretty hard to take a negative in that. And if you do, you're probably at least not going to take a negative that is, you know, too bad. Maybe it's a break-even trade. So even if you're wrong, you can still pull a profit, or you could just use the next expand low point as your actual target. So you're not even worried about getting into the overall trend. You just want to see what happens, see if it makes it past the expand low point. So you use that as a target, or maybe the liquidity line right here at the low, because there's a really good chance that it can go down to that level. All right. So that was the point. Yeah, so I'll be looking for any questions. Wade, is there any comments that you have as far as the origination point and helping with some of those, helping you get into a trade and manage the basic strategy?
No, sorry guys, my throat's a little scratchy this morning, so no, I think you did a good job explaining that. One thing I want to point out to everybody on the webinar is that if you're sitting there and maybe you're new with us, and you're just like, I'm lost, like I don't get this expand high, expand low talk. One thing I want to tell you is that if you go off the basic strategy and the videos that are in the online course, that naturally falls in line with what Shane's talking about, or when I talk about the master pattern origination point. What we're explaining is basically the mechanics behind what the software is built around. So don't worry if you're not understanding every single technical aspect of what we talk about when we talk about that deeper subject. As long as you stay in trend and you buy either below or above your expansion line on your entry time frame, that's going to typically put you in a strong position, which is what we're endeavoring to do with the software. Is we're trying to enter the trend in a smart way rather than just jumping in arbitrarily like most people. Like they're either jumping in on a moving average crossover or their MACD crosses, something crosses, and then they're getting in. We're trying to give you much more of a price action framework to understand. So when you're looking at the chart, you're looking for the basic strategy, you're looking to enter the trend, you can just have a little bit back in the chart history and saying, where is there a predominant master pattern happening? And if there is something that I can clearly see, where am I in that cycle? That's really what it's just supposed to give you a little extra insight, and it's supposed to come over time. Believe me, this is not something you're just oh, okay, I get it now. If you want to do yourself a favor, just stay in trend. Yeah, regardless if you're using ATS methodology or not, staying in trend is really the only way to consistency, in my opinion. I think ranging markets are a mirage. very difficult to navigate. Trends are where we're going to go somewhere, but that's really what I want you guys to understand when Shane talks about the master pattern, or when I talk about it. It's just helping you understand a little bit of the mechanics behind the price action that ATS is built around. And the better you get at seeing that pattern, the more you can't unsee it. That's one of the things, and that's why we stuck with it so long and built the software around it, is because it's the only pattern in the market that not only adapts to all the market cycles, but it's constantly present. So there's no way to overlook it. So, but anyway, I think you did a good job, Shane, and that's pretty much all I just wanted to put out there. But go ahead and wrap up, and then I'll take over when you're ready.
All right, thank you. I was going through while Wade was going through that. Just wanted to bring up one more example so we can see inside of the Dow. And also you look at this, I mean, it applies to the Dow very similarly as it does, gold. This applies to every single pair. They're all going to work out exactly the same, and every single time frame, granted that you have enough distance in between your entry and directional bias. So we're inside of a long push right here, and then we form a new origination point right here. Well, at this point, we don't necessarily know if it's going to continue pushing long, but we knew for sure that it was an expand low, expand high, expand low. We knew for sure that there's probably going to be a range right here because we started a new master pattern with this box after this big push up long. Then price goes. This wasn't a very clean, or not as clean as some of the settling that we get, but we can see push through the, some of this liquidity came back, reacted to this origination point from way back here, and then ended up pushing to the long side. That brings up one more point that I wanted to make. Even if you don't necessarily get in at the expand low point, the perfect expand low point, just watching as the range develops and getting in, back to what I was saying about the lowest or highest boxes inside of a given range. So we can see range started right here, and as it progresses, this was actually the highest box that we had right here, and then this was the lowest box inside of the range. We had a little reaction to this expansion line here, but that wasn't the highest box in the range. Lowest box inside of this range, price breaks out and then rotates right off of that expansion line, letting us know that the lowest orders, contracted orders in this range are being protected, and then it goes in into a push. You're going to see that over and over and over and over again. It basically just comes back to get strong entry. If you're trying to go long, it's pretty straightforward to see that it's a range right here. Don't enter right here. Enter on the low side of the range. Enter on the low side of the range. That's really what this entire thing is about. All right, got a request to go over that again. So we knew that there was a new master pattern formed right here, or at least a potential one. We didn't know if it was going to turn into a range until we got back right here. So we have expand low, expand high, price whipped around, maybe you thought it might have still been in trend at this point, and then expand low. Okay, we have a for sure 1, 2, 3 leg expansion right here. We ended up pushing this low a little bit further and then came back up, did not take out the high, but we know that the high is our next target because after an expand low is an expand high until price settles, that is. So after we had our expand low, then the next, let me scrunch this up a little bit. So expand 1, 2, 3, and then 4 ended up being it just going back into trend. But again, you're not trying to trade short in here because you know that we're in a primarily long market. So back to the lowest box in the range, lowest or highest box in the range. It just depends on what your trending direction is. So we formed a few boxes through here. As of looking back at this range, this was the highest box in the range. and this was the lowest box in the range. We have a directional bias of long. You can see it was creeping up long all through here. You know, we're up above the most recent expansion line. We're getting a little bit of a reaction right here, but long was our directional bias. We get the lowest box in the range, and then we get a reaction to that off of the expansion line, and then it starts going into, you don't even know that it's a trend at this point, but we are expecting that the target is this high right here, because that's the expand high. All right, so that was from Oberlin. Oberlin, did that make a little bit more sense? All right, I got a few comments through here. Give me one moment just to read these. And hold on one moment. All right, Marco, I see your question. Could you rephrase that a little bit? I'm not quite sure that I understand it. I want to make sure I get it right. All right, so here's a comment from Saeed. Saeed says, price is near a liquidity line right now. Wouldn't that be a potential time to maybe test a short entry? Definitely. At some point, price is going to turn, you know, we would all look at this and say, oh, okay, that's starting to get into the realm of overextended. And if you are going to short a market, it's best to, or if you're going to try and trade a reversal, at least do it at a higher probability point. So after price pushes and we can see that we're getting a reaction right around here, right around the liquidity line, then, you know, we can try and trade that if you want to, or you can just stick in trend and wait for another expand low point. But in this case, so we came up, here, let's look at that. So we formed a master pattern. It looks like we took out the liquidity on the 4-hour with these right here. And then we pushed up, formed a new box on the 5-minute, had an expand high, expand low, and then expand high right here. And that was after that liquidity got taken out. Then we formed a new box at the top of the range. And then we had a rotation off of it that was actually another master pattern, expand low, expand high, and we rotated right off of that expansion line here at the top. So if you did want to try and trade right there, that was a very wiki little entry in there that probably would have been pretty hard to hold on to, and also a little bit scary when it starts waking up. You know, when the actual candle body's up here and it's, you know, just there off the high. That's and the, you know, you're looking at this candle that was probably blue at that moment. Might have not tested that trade, but you know, in retrospect, we can see it ended up working out. But you know, always a little bit freaky in the moment. But you know, regardless of this sort of behavior happens all the time, where you don't, you know, where it doesn't happen to be a scenario where you're wondering about whether it's going to keep on trending or not. So just, you know, focusing on the highest and lowest boxes for reactions at those, and looking at the general expand high, expand low points. One more thing that I think I actually failed to mention, which I can't believe I forgot this. When you're looking for where potential expand highs or expand lows will go, so after you form an origination point and you're looking for expansions to the high or low side, they tend to go and take out all of the liquidity that's nearby within that range. So what do I mean by that? We had an expand high, expand low, and then our expand high went and took out all the liquidity. Something that you need to be aware of, if your expand low goes and it leaves a little bit of liquidity behind, that's usually something to be suspect of, because the whole purpose of the expand high and expand low is to pick up liquidity for institutions to place trades of their own. So they need liquidity to do that. So you're going to see the expand high and expand low end up taking out a lot of that liquidity. All right. Sorry, just looking at some of the questions real quick. All right, and got a question from Randy regarding USD CAD, just kind of looking at the master pattern on that. Yeah, we can do that real quick. All right, so 4 hour, we have formed a master pattern right here. So this is still pretty new into it. We're inside of a long market. We formed a box. That master pattern did not take shape because after our expand high, we formed a new box, but now we've got expand low, expand high, and now we're coming back down into this. Master patterns get a lot more useful once you actually go through and you get that third leg of expansion. Because if you can hit it, it comes down through the liquidity line and then it starts rotating back up. On your directional time frame, you don't necessarily want to look at getting in on the expand high or expand low. I would recommend just looking at it as an overall, just to the ebb and flow. Know that if you're in a market that's going up long, you suspect that this is long and it does end up taking out a previous expand high or expand low point, just be cautious of it. But we want to ultimately follow along with our higher time frame direction. As far as actually practically applying it to your trading, it's going to be a lot more useful on your entry time frame, because then it'll help you fine tune those entries and get in at a general level that's going to be a lot stronger, because telling the exact trend is really difficult. We just have to kind of look at it, and using our experience and some past reactions, we have to not guess, but make a very educated guess on what direction we think the market's going to ultimately go. And while we're doing that, we want to at least give ourselves the best shot by getting a strong entry into that trade. All right, so question from Mindo, please elaborate on suspicious if liquidity is not taken out. If liquidity is not taken out, that may mean that something else has got to happen. So here's an example of it not getting taken out right here. So expand high, we had an expand high right here, past the expand high point out of this origination point, expand low, expand high. We actually ended up having a little reaction to that origination point, push down low, did not take out the low there, expand high, did not, I wouldn't even consider this an expand low because we didn't take out the original expand low point. It's 1, 2, 3. I would consider this a breath back and then push to the long side. So whenever you don't take out liquidity, you just have to be a little bit careful, because we could get into a position where that's just not the final expansion leg and there's a breath or something's going on. But generally, most of the liquidity inside of a range is going to be taken out. This one was a little bit difficult. We can see we actually formed another origination point down here that was the lowest box in the range, and then expand high, and then it came back and we actually ended up settling off of that origination point. That was a little bit more difficult. But in that case, if you don't understand what's going on with that, then probably just wouldn't trade. But very, very often you'll find that original origination point, it'll come back and it'll end up testing it, and then it'll be a nice entry into your trending market. All right, I think that's mostly all of the questions that I can handle while going through this live. I'm going to spend a little bit of time going through answering your questions while Wade is going through looking at some pairs. So we're also going to adapt some of this lesson into a video that's in the classroom. So be on the lookout. We're going to kind of cut back and forth, as I mentioned, between the live lesson and some more canned stuff, just to kind of help really cement all of this stuff in, because I think it'll be really helpful for you guys just as far as finding good entry into trades, and and also having a little bit better sense of which architecture lines, which expansion lines are more important that you got to pay more attention to, and where the liquidity is and how likely price is to push and take out certain levels of liquidity and stuff like that. So just an overall better sense. So anyways, thank you guys for going through that with me, and I'm going to hand it over to Wade.
All right. All right. Thanks, Shane. Appreciate it. Let me get my stuff set up. Can you guys type in a Y? Let me know. Let me know that you could hear me all right. All right. Looks like we're good. All right. Thanks, guys. Appreciate it. All right. So I just want to reiterate what Shane was going through. I know it may sound like I'm never going to get this. Like, believe me, it's important to know it's there. But the most important thing that you guys can do is just get good at identifying that trend on your higher time frame. And then if you the better you get at spotting those origination points, it's just going to be a little extra tool that you have that'll help you just kind of wait more. Like Shane says, you have expansion lines that you want to pay a little more attention to, and some that you'll pay less attention to. But again, if you didn't know anything about what he's talking about, if you just went off the basic strategy, sometimes that's the best course of action because it keeps it very, very, very simple. If your higher time frame, like what we're looking at right now, USD CAD, 4 hours above expansion, 5 minute under expansion, you're trying to get back to expansion. That's your basic trade from the rotation here to here. That's your basic trade. If you get above expansion, now you're in the bonus round. Very, very, very basic. So, but we get a lot of people that they're not happy with the basic. And that's why we go into that stuff. It's like they need to know how the watch works. They don't want to know how to tell time. And so, that's why, we'll talk about that a little bit. So you have some insight into how the software works and things like that. But again, we try to figure out all that stuff. We try to figure out all that stuff and put the software in place so that you guys don't have to know that. You're just looking at a screen that naturally adapts to that pattern and puts you and shows you potentially strong entry points in trend. That's really the simplicity that we're going for at the end of the day. So anyway, we got some questions here that I wrote down, was going through and just checking out what you guys were writing in. One thing a question was what time do we trade? We're in California, so time zone. It's actually not a great time zone. Honestly, if I didn't have little kids and a family and roots where we're at, I would probably move to like London time zone because I think everyone in the London time zone literally has the best workday as a trader. You're there for when the markets get ramped up, and you're basically, you can work a little bit late and go into the New York session, and you really get to catch the best of the best. So anyway, it's definitely. I wish I could live there, but it's not feasible. Maybe sometime later when my kids are grown up, then we'll go over there. So sorry. Hopefully you guys can hear me. I think my internet just cut out. So if you guys just let me know you can hear me again. Just type in a Y real quick. I want to make sure that I'm connected here. Okay, looks like I'm still on. Sorry, my other computer's having some issues, so I had to get set up on a laptop here, and I'm on Wi-Fi, and it's just not nodal, not what I'm used to here. So anyway, going back, so with California, basically what we can do, the best we could do is short time frame trading, is trying to catch basically the New York session. You're basically trading, the New York session, London into New York, starting around 5:30 a.m. if you're in California time zone or around here, and then basically trading to like sometimes the way the markets have been moving, sometimes it go up to around noon. And then the time frames best associated with that, I feel, just my opinion, are the 5 minute into the 4 hour, is probably honestly the best for that time zone. The 15-minute is good too, just because you won't potentially overtrade as much because there will be less setups with the 15. But that also is kind of a double-edged sword, because then you may have days that go by that the 15 does not set up. So 5-minute will give you a little bit more opportunity to shoot at in this time zone. So I'd say 5 into the 4 hour for short-term time frames is the best, for having a balance between opportunity and not being super terrible for over trading. You can also do the 1 minute into the hour, but that is contingent on the spread. If you don't have a good spread, if the spread is, or if you don't have good movement according to spread, then the 1 minute is not really super feasible. The USD or USD, US 30, let me pull that up right now. This you can really do some damage with, as far as, well, you do damage in good ways and bad ways. So, but you take like the US 30 and trade a 1 minute into the hour, but see how tight the spread is relative to the actual movement. This is something that you can actually get away with trading. Now, if you trade something like something that doesn't typically move that much, like dollar yen. Where's dollar yen here? There it is. Okay, it's actually not moving too terrible. But anyway, usually like dollar yen can go sideways quite a bit. It's not super volatile sometimes. Well, it's been moving a little bit. But you see how big the spread is compared to the movement. So the reason I bring this up is that when you're trading a 1 minute chart, realistically, the way that the architecture works out, you're probably going to be booking 5, maybe 10 pip trades, typically most of the time. So when you have a spread of 2 pips and your average trade is, let's say, 7, what percentage of 7 pips is 2 pips? That's kind of what you have to climb over every time you click the button. And if you're trading 1 minute, you're going to click the button much more frequently than trading higher time frames. So you got to think about that. It's like, what kind of battle are you putting yourself up against just initially, just to get in the money? So that really is what makes low time frames like the 1 minute really mostly, not worth it to trade. It's gonna put you at too big of a percentage disadvantage right off the bat with the spread. But going back to the US 30, and sometimes in gold too can have a pretty tight spread as well. But look at compared to the movement, see how tight this is, and especially when the movement really gets swinging, you're almost in the money immediately on this pair. I mean, just because it's so tight compared to the actual movement. But again, there's big risks with that too, because obviously there, with a lot of volatility, if you don't get it right, you got to be prepared to make the call and get out of the trade, because this will run against you real fast. So no substitute for good money management on that side. So anyway, but so back to the original question, if you're in California time zone, just my opinion is 5 into a 4 hours good. Line up the 4 hour with the weekly if you want a little extra confidence in the trend, meaning wait till the 4 hour is the same color as the weekly candle, then look at your 5 minute. Because if your weekly is holding blue, especially by Tuesday or Wednesday, and your weekly hasn't changed direction, chances are the rest of the week is going to go in that same direction. If that's the case, then all the predominant moves on the 4 hour are going to be in line with that weekly direction. Real simple mechanics there. So that would probably be your best bet. If that's not going to work as far as lower time frames, then I would suggest moving up to trading the 1 hour into the weekly or the 4 hour into the weekly, depending on your job. And remember, I've said this before, if you're trading a higher time or whatever time frame you're trading, you need to make sure whatever your entry time frame is, let's say it's a 1 minute chart, then you need to be able to look at that chart at least once a minute. If not, and realistically with that, you need to be looking at it nonstop, because that's how fast it can move. If you're trading a 5 minute chart, you need to be able to look at your chart at least once every 5 minutes. Oh, if you're trading a 1 hour chart, you need to be looking at that chart at least once an hour minimum. So if you are trying to tie in trading with an existing job, a work schedule, we had a trader that we worked with years ago that was he was a dentist in Canada, and he had to use he loved trading, but he's like, I'm losing all the time. I don't know what my problem is. I feel like I know what I'm doing. And I asked him, well, what time frames are you trading? He says, well, I'm trading a 5 minute into uh, into a 4 hour. And I said, well, what are you doing all day? And he says, well, he says, I'm seeing patients, so I'm in trades and I'm going and I'm checking my charts as after I see patients, I'm going back and forth. And I told him, like, well, how are you going to pay attention to a 5 minute chart? You got to look at it every 5 minutes. And so anyway, the point is that if you can't manage that trade uh, based on those time frames effectively, then you need to switch it up. So what improved him quite a bit was going to a 4 hour chart, because then he wasn't stressed about doing his day job, and then he knew if he checked the chart at least once every 4 hours, that was typically going to be good enough. So with us here in California, that's typically the best thing, is doing longer time frames, I feel. um, Unless you could be up and ready to go for that New York session, and even then you're kind of getting the tail end. It's pretty frustrating when you wake up and you see that London has ran you know 100 pips on your favorite pair that you're used to trading, and you get up for the New York range because then the range, it's probably going into contraction on the higher time frames by the time you get up. So anyway, it's just something to think about. um, but I definitely, I think it's safer to stick with the higher time frames. And regardless of your time zone, I feel like if you're trying to just get started, a big problem with people getting started in trading is over trading and the tendency to want to use high leverage. Because you're like, I'm a trader now, I'm on the screen, I need to make some money, so I'm going to up my leverage and I'm going to get out a 1 minute chart and just start tearing it up. I believe me, I get it. But I'm telling you right now, it's pretty much a recipe for you're going to blow up at least once or twice until you learn to respect the movement of forex and whatever else you're trading. You have to really form a deep level of respect and understand that how to interact with it correctly. So um, anyway, that's I would suggest, if you're new to trading, I would look at the 1 minute, the 5 minute charts just to get used to movement, not necessarily trade them heavy, but just to get used to seeing especially how the software forms, and just get an idea of how it works. But when it comes to trading, the higher the time frames that you trade, the slower the decision making process has to be. So if you're trading a 4 hour into a weekly and then backing your weekly up with a monthly, you have a lot of time to think, and even possibly sleep on it. Something could go against you. It could be like, oh, I'm a little uncomfortable with that, but you can typically get some rest that night, wake up fresh, reevaluate the position, take some precautions if necessary, figure out what you're going to do. It's a much slower thought process. Whereas if you're trading a 1 minute chart, it's like you gotta make decisions by the minute, by the second. So anyway, it's just some of my 2 cents on that. Like I said, just my opinion, but at the end of the day, do what works for you guys. I'm going to take a look at a couple of pairs here. We're going to look at Euro USD week into the hour for Joel, or Joel. I don't know how you pronounce it, but let me take a look at this for you. So we got Euro USD. We're going to take a look at the week and the 1 hour. Oh, this isn't terrible. So let's think about this. We do have a drop back. We've had this pull up from here. So this is a possible entry point. Okay. We have a blue candle here. Now, if this candle goes yellow, if you're buying this right here, I would probably dump that trade, because you don't want to get stuck in a yellow drawback. And also, to keep in mind, is this overextended or not? So let's look at the expansion index. We're above normals. Okay, we have pushed above what is the normal range for the long side of the market. So the expectation, now we could keep going long, but really, this was the best meet of this weekly trend right here. However, it's still blue. So I'm not saying it's not a valid setup. Just understand that all trends don't go forever. And you have a gauge down here to tell you what's normal. So what you know about this trend right now since this expansion point is it's above normal. So let's put that in the back. Let's put that in our mind, right? Let's just put that in our gray matter here for just general decision making. We know that the weekly trend is a little bit, we'll call it overbought. We'll use that term, right? So we have that on our tool here. But we do have what looks like a possibly good entry. So what do you do here? Do you guys go heavy? Do you go all in on this opportunity right here? Is this a good time to be like, I'm just gonna go high leverage and this is not a grade A opportunity. It's a grade B or a C, because there's been so much opportunity already. So I'm not saying don't trade it, but you probably want to trade something smaller, especially to start with. Now, the second thing is going back to what Shane was talking about earlier. Do we see anything in here in this recent market that is a possible multi-leg expansion happening to give us swing high and swing low points to use as possible entry targets, or just to understand where it potentially could go? Okay, right down here we had a box that broke short and broke long right here. So this possibly could run all the way down to this liquidity line right here, because that is the swing low point of this origination box. That's a potential. So we need to put that in the gray matter, right? We just need to put that there for our decision making. Again, right here, we had a breakout high and a breakout low, which the expansion lines that don't have boxes naturally are more, they're going to show you more origination points, because they have already confirmed that you've had a swing high, swing low point, and that there was a minor contraction back in the recent price history, but it wasn't enough to render on candles like we do with actual boxes. So, these ones could definitely be a warning that you're going into that multi-leg expansion range. So if that's the case, where's the swing low point? And any of these also can turn into swing low points. That's why the liquidity lines are there. So if you're going to buy here, one of the things that I would recommend doing, again, just my opinion, is I would use the architecture of the expansion lines. We're holding below this one. It looks like we're holding. You can see that we came down. We kissed this one right here. So if you're going to enter, I would really not want to see price go much below here, or the worst case would be this liquidity line. I would want to see a strong reaction. If you don't get a strong reaction off this liquidity line, there's probably a good chance that you're headed down to here. And if you're headed down to here, what's that going to do to this weekly candle? That's going to turn that yellow. And again, just my opinion, one thing that you don't want to do is when you're using your directional bias time frame and it turns a different color on you, you want to definitely get cautious at that point with protecting your position. And I'm not saying just immediately dump it, but you're going to be very sensitive on your lower time frame to say, okay, how much more room am I going to give this? Because when this isn't supporting your trade anymore, you got to start asking yourself those questions. So going back to this entry, just my opinion, I'd be looking to buy, in this zone with a small position, maybe like 1/4 or 1/5 the position that you would normally want to trade on something that was a little bit more, sooner to the trend, like in this neighborhood. So 1/4, 1/5, test the entry, and then define an entry range, kind of like where my green lines are. That's what this money management tool is for. So if you don't want to risk more than 2%, this is for one position, obviously. But like, let's say it's 2% max that you would want to risk, and you wanted to use 4 positions. So let's change this to we'll do 0.50. So it's a 0.5% of risk. There it goes. Okay, so you do that with 0.5%, and then change your lot size down to whatever it's going to work to change your money management range. And so you could adjust that. So you could probably, let's put in 2 lots. Okay, so see if we buy the market, see how this green line is below here. This is, in my opinion, between this expansion line and this liquidity line is kind of your general range that I would want price to stay in without getting out. So if you put in your first position here, maybe it goes against you, you put in another position here, you know, you're still within this original 0.5% range, and you're prepared to put in 4 positions and test this entry because, again, it's so high in trend, you're overbought, you don't want to go heavy on this opportunity. So that's what you could do, is you could adjust those and figure out what's a comfortable position to trade based on how many trades you want to put into the market, and then how much overall percentage risk you want to put in there. And you can see that there can be a very safe way to enter or to test a situation like this. And also too, you don't have to buy when the market's just going against you. If it turns, you could put in another position as well, because you're still ultimately, if this trend is going to pay, where's your initial profit target? It's going to be right here. This is the highest expansion line in trend right now. So that would be, you'd be looking to get just to here. So that's your initial upside from where we're at right now, about 41 pips.
Hey, Wade, can I jump in here real quick and just have you show them that if they were going to go in and they were going to layer into this, what I call the rip zone, if they were going to layer in, to make sure they understood that the very first entry that they make, that they drag their stop to that green line, so it gives them the bottom end of their trade zone.
Yeah. So what my dad's talking about is, let's stick this at 2. Oops, I just put this on here. Okay, so let's stick this at 2. So what he's talking about is that you've already adjusted these green lines. Now you're going to drag your stop down to right here. And that's your, I screwed up. Good thing it's not live here. Anyway, it would be, oh wait, no, never mind. Sorry, I'm rambling around here. So anyway, so that'd be your first position at 0.5% risk right there. And that really would define your bottom zone right there. So you can see right there that would be really your risk tolerance that you wouldn't want to go past at that point. So that's what he's talking about. Hey guys, hold on real fast here. I got to check on something. I'll be right back. Dad, if you want to talk about anything else on that, feel free. Hang on real quick, guys.
Yeah, so let me just reiterate what he's saying there. So those green lines are going to move. And so you've got a zone there that you're trading with your trading idea, which is that you have that expansion line, and you're looking to trade it back towards the expansion line that is that's going long in the direction of the weekly candle, right? So when you drag your stop down to that first green line, when you make your first entry, if that goes against you and you're going to layer in with another long trade, but the trade's going against you, that first stop line gives you your maximum out of your trading range. So in your second trade, if you were going to go in and layer in, you would again drag your stop on the second, third trade, depending on what your trading idea is, to the same exact line. Because as you start moving in and that trade goes against you, the green lines keep moving down. You don't want to go past the first stop that you put in on your initial entry. And that way you're always closer to your out, and then you're minimizing your risk if the trade goes against you.
Yeah, and one other thing with that is that if you do go off of this first stop loss level, with all of your trades that you plan on, let's say you plan on putting on 4, that'll actually keep your overall risk under 2%, because you're only at half a percent risk. and the closer you get to this line, it's going to be even less than that. So you could also, as this goes, you can up your lot size as well, because you know that was kind of your risk line, and then keep it at 0.5, and you can just tighten up these green lines with that original point, because you know that ultimately this is where you close all trades. And there was an email that was sent out. Let me see here, or it was an email request for what's the best practice for. I'm trying to find the comment here, guys. Sorry about that. Oh, from Mark here. Um, Sent an email. I apologize, Mark, if we didn't get back to you. We've been getting kind of bombed with emails lately, and so a few things have fallen through the cracks. But I apologize if we missed that email from you. But Mark was asking, what's the best practice for layering in trades? The best practice is figuring out beforehand, before you start the sequence, figuring out where does this whole idea fall apart. And for me, if you get much below, this, if we don't get a strong reaction around this liquidity line here, then I would start to second guess the validity of that weekly chart. Because if this isn't going to support you, then I'm not going to go on a bus ride for what could possibly be weeks. If this turns yellow and closes yellow at the end of the week, you could be looking at 4 weeks, even if it's a short pullback, 4 weeks against you, that you'd be riding a negative position. So that's really, you need to judge beforehand, where does this weekly really start to fall apart, and find that point here between the architecture on your lower time frame, and that becomes your, like my dad says, like the rip zone. That's where you're going to build that position overall. So anyway, it's this more of an advanced entry, situation, but it's something you guys can experiment with. And the key thing is that you want to keep your lot sizes small when you do that. You do not, the biggest thing is staying in the game. Most people are going to get bored. They're going to get desperate because they feel like, I need to make progress now. I make $200 or $300 a day at my job. I need to make $200 to $300 a day trading immediately. So they're going to put in the minimum amount of money that they can to get that the leverage that they feel will get them enough to make that kind of money per day, and then they're going to go balls out and try to attack the market. That's not the correct way to do this. You have to approach it with a very slow, stable mindset and low positions, to stay in the game. So anyway, just something that you guys can mess around with. If you need practice, do it on a demo account and just get used to building those positions out. And that way you can just kind of get used to the process. But use these green lines here. That's what those are for. Those are to keep that reference point. The range, the safe range that you need to be in based on having a good money management, depending on whatever your account size is. And those will really help you make smarter decisions rather than disregarding them and just shooting a high leveraged bazooka at every trading opportunity. So anyway, I'm not going to get too much more into that. Let me go I'm going to look at a couple more pairs, and then we're running a little bit long here, but hopefully you guys are getting something out of this. I'm going to look at pound yen, 4 hour and the 5 minute. So let me find it here. There we are. Okay, so 4 hours in a box. So that's pretty clear. Let's take a look at the weekly just to see what the expectations are. Weeklies, this pair is kind of all over the place. Weeklies yellow on the downside, definitely could get a mean reversion back to here on this expansion line. So if that does happen, there's a possible 324 pips in that. So when the 4 hour breaks out, there's a possibility that you can get a 300 some odd pip drop out of this box, but overall this thing is going pretty sideways. And then you can see, I'm sure you can See that represented here on the 5 minute as well. So I would say that this is, you want to wait. You want to give this one, I would probably give this one till next week, because even if it does break out with 4-hour candle, you know, by the time it breaks out, we're going to be probably into Wednesday or Thursday. So I would say that it'll probably set up by next week is when there'll probably be something more to look at on these time frames, but nothing right now. Let's take a look at pound USD. Okay, from Amin, hopefully I'm pronouncing your name right. Sorry about that. He says, my 4-hour pound yen doesn't have a box. You're on Owanda. So we've addressed this many times, but the way that this is, it draws boxes, just so you guys know, is that it is 100% dependent on how your platform receives data and the data stream of the broker. And it's literally to the pip specific. So if you have certain candles that are even 0.1 pips bigger or smaller, it could be the difference whether you have a box or not between platforms. The only way for us to mitigate or to remedy that is literally to have everybody on the exact same computer connected to the exact same internet on the exact same broker. That's the only way to control all the variables. So, but overall, even if you guys are missing a box here and there, you should overall have the same story and come to relatively the same conclusions. So again, it's something that we can't get around. It's highly dependent on the price action data. So, okay, so was I looking? Okay, yeah, pound USD. Let me get over here. Okay, so pound USD is broken out long right here. It looks like we respected the average price here out of the box. We're starting to get a pullback on the 5. It's still pretty sideways though. Let's take a look at the weekly just to understand. So weekly on pound USD looks very much like pound yen. There's a possibility we could still go long here. Honestly, I wouldn't get real excited about staying long above the 4-hour. You know, I really wouldn't want to trade that much right here because the weekly is yellow. And I'm not saying that this can't just be a major reversal. It very well can be, but we're trying to put things in alignment in your favor, right? And right now that weekly is yellow. So I would really wait till you get up here, turn the weekly back blue and fall in alignment. Otherwise, if you feel comfortable trading against expansion on the weekly, I'd wait till you get yellow below this expansion line and then start trying to rip the 5 short. Right now, in my opinion, I'd leave this one alone. Aussie USD. In fact, I've been putting a ton of time in on the new scanner, and I was looking at it a little bit ago, and trend strength, that it's that new proprietary function, is pretty much dead on most pairs. In fact, I'll pull it up for you guys real quick so you guys could check it out. Oops. So this is not going to have all this. This is all just data that I had to put in there. So just ignore all that stuff. Okay. So, okay. So you see the trend strength, I was looking at this, they're all 0 right now, and just showing that all these markets, and I have this running on a minute 1 into the hour with a supporting daily time frame. Anyway, you can see that all the trend strength, this is that proprietary number that's going to show you the strength of a trend. You can see it's all at 0, short 0, short 0, short 0, short 0, long 0, short 0. So most of what it tells me is that all these markets on the lower time frames are not really going anywhere. So anyway, I think I'm super excited about this tool. You guys are this thing's gonna kill it. Like it's gonna be really cool. So Aussie USD on the 4-hour and the 5-minute. Let's just glance at the weekly. Okay, weekly's long. Where are we at on the expansion index? We're still under normal, so I would still be sticking long. However, how many weeks have we had that are blue? You know, quite a few here. So again, it's one of those things. I'm saying not, don't, if you're trading like the hour into the weekly and you see a setup, I'm not saying don't take it, but keep in mind where you are. You are getting pretty overextended just because you had so many weeks in a row. But if you are going to trade, you definitely want to stay long. Just don't go crazy. So the 4 hour is now you're above the last expansion, but you have a yellow candle here. So I'd be looking for that yellow to turn blue. And if you're trading the 5 minute into the 4 hour, actually this one was a request for the 4 hour into the 15. So let me switch this up to a 15. Okay, so the 15 into the 4 hour, you're starting to go yellow right here. So if you rip this long right here, and now you're starting to see yellow over here, what's the potentials that can happen right here? Well, I would say just based on the gravitational pull of the expansion lines, that there's a good chance that this yellow can whip down to here. So when you're entering right here, you need to be prepared for that. What price is this at? So 0.72756. Okay, so it's very close to this expansion line right here. So you can coordinate, typically if you have an expansion line on your higher time frame, you can find one on the lower time frame that's in the same general price area. So what that tells me is that I know there's a good potential this thing could come all the way back to here. If that happens and you're long right now, that means that you need to be prepared risk-wise for this to come down to this level at least. If you're long here, depending on where, what you're at position size, that's all up to you guys. But I would really want to see it keep making progress. If you've bought down here or like on this turn, I would be putting a pretty tight stop loss, like at least like at this low, maybe even a little bit above right here. Because chances are if you take out this low, you're probably coming to here. Because then what that's showing you is a 15 minutes going to precede the 4 hour, but the 4 hour has changed direction. So that's a predominant push to the 15. So you just ask yourself, if I get down here, do I want to go to here? And if your answer is no, then you better cut it here. Always think risk first, right? So, but hopefully it stays above and it'll pull this back blue and then you'll whip back up to the top. But again, you need to manage your risk on this one. In my opinion, I'd manage it tight around this range. And I wouldn't really much care to go below this active low right here on the 15 minute. So, and we'll look at Aussie CAD as well. So let's take a look, get a sense for the weekly. Okay, weekly, we got some new blues right here. And what I like to see on this, we are pretty far away from expansion line, but here's an argument for this as well. This actually doesn't look like it's too bad of a trade, honestly. Never mind. I'd have to look at the 1 hour. Let me look at the 1 hour real quick. Never mind. There's no trade yet. But if you pull back down below this expansion line, I would say there's a possible trade. If you or we get a new expansion line, you get below. There's a possible trade to go long. I still wouldn't go super heavy on it position wise. I'd be careful of that. But what I see right here is that we did push long right here. You see on these bars, and it kind of had the opportunity to go yellow again on this bar, but it didn't, and we're still building long up towards the active high up to here. I would say there's a decent chance, probably above 50%, that we're going to snap this active high again. And if that does happen, what's the upside? There's about 81 pips to the upside. Just a scenario. You still need to find good entry and control your risk. You got to do your homework on the lower time frame. But the weekly doesn't look too terrible. So it may be worth a shot if you get the right positioning on the 1 hour. Now going back to the 4 hour, obviously the weekly is long. The weekly looks promising to push long again. So if that's the case, what does that say about the 4 hour? 4 hours above, it's just crawling up, push up, pull back, push up, pull back, push up, pull back, holding above our last expansion line. We just pushed through this expansion level. See how price came down and respected that level of architecture. So I would really look for this to go long again, and then find your opportunity on the 15 if you guys are looking to trade this. Right now, you do have a rejection happening on the 15 right here. So if you do want to buy this and you feel like that this is going to get dragged blue again, you still got, at least on my dealing platform with FX Choice, you got 2 hours and 31 minutes for that to pull long. Granted, we are getting out of volume here, but another thing to take into consideration. But if you did go long here, I would, because it respected this architecture, then I would really go off of that. I feel like you can control your risk pretty tight by buying right here and not letting it go below this low right here. But I would expect it to make immediate progress up to your highest expansion line and trend, which is right here. If it craps out and doesn't keep going, I'd probably just take a small profit and forget about it, because we're about to go into the dead part of the day. So again, just my opinion. You guys can do whatever you want. So yeah, I think there's an opportunity there on the 15 into the 4 hour. The expansion index isn't above your averages, so there's a possible room to push on that as well. So yeah, anyway, there's opportunity there. Again, just manage your risk, figure out where, before you ever pull a trade, figure out the price level or the price range where that idea turns into it's no longer valid. Figure out where that point is, and then reverse engineer your money management based off of that point. And that's, you just ask yourself that question. If I buy, I have the feeling that this price is going long or short on my entry time frame. At what point do I feel that this price or this idea falls apart? And find that point on your chart and work your way backwards into the trade from there. So, all right, guys, sorry for taking a little bit longer there, but hopefully you guys got a little something out of that. Appreciate everyone being on. We will plan on seeing you guys on the webinar next week. And also, by way of announcements, we're just working hard on stuff. You can see that we're putting a lot of emphasis into this. I'm putting a lot of emphasis into this, the new assistant/scanner. I think this thing is going to do such a tremendous amount of heavy lifting for you guys. I'm trying to get it really, really, really dialed in to make your guys' life easier. So anyway, I'm hoping to have something on this. I'm hoping to have a final version to do final testing on by Friday of this week. And then once I have a final version, then we could do final testing probably for a few weeks amongst my team. Make sure everything works, doesn't crash or have any load errors or anything like that. And then, shortly after that, hopefully we can hand it out to you guys. But I think this is a really big deal right here. I think you guys are going to really like that. And again, as long as you guys stay subscribed, this is something that will be included. It'll just be available to download. However, I will tell you that we are talking about raising our price. So we want to kind of cut the supply of people that are joining. We want people to be more serious. So we're probably gonna end up raising the monthly price here at some point. I don't know exactly when. So if you do unsubscribe, it's up to you. We don't want anyone using these tools that's not feeling like they're benefiting from them. So by all means, move on to something else if you feel better that way. But we do want you guys committed for the long run. So as long as you stay subscribed, if we do raise a price, you guys' price won't raise. You'll always be locked in at the $150 a month right now, as long as you stay current. But if you leave and you come back, I can't guarantee that. So we don't like to play price games or anything, but we give this stuff out at such a cheap upfront fee because we want you guys to stay a long time. I know I've said that before, but that's our business model. We want you to test the water. If it makes sense, great, stay on with us. If it doesn't make sense, no problem. It's not going to resonate with everybody. We don't expect it to, but our business plan is we want you to trade with us for a long time, 10, 15 years, or as long as you're trading and, benefit with the new tools we come out with over time. So, that's where it makes sense for us to do this in the long run. So hopefully you guys understand that. And I would just say as long as you guys stay subscribed, then you guys will for sure be able to download this, and whatever software stuff that we come out with in the future will always be available to you. So, all right, guys, thank you so much again for being on, and we'll plan on seeing you guys Monday at 10 a.m. next week. Until then, stay safe, don't over leverage, stay in the game so you can be there when those good opportunities come and present themselves to you, and
Hey, Wade,
keep heading towards success. Yeah, what's up?
you just said Monday. It's still Tuesday, right?
Yeah, Tuesday. Yeah, if you
Yeah.
come here Monday, you'll be lonely because no one will be here.
All right. Just want to make sure it's the other Monday, which is Tuesday.
Yeah, there you guys go. All right, guys, thank you so much. We'll talk to you guys later. Thank you. And also, if you guys need any help, always feel free to email support@tradeats.com. We're there for you. We love to help. And if we take a little bit long getting back to you, just know that we do get a tremendous amount of emails. So sometimes we get behind, and every once in a while something does fall through the cracks. So just send it again if you feel like if it's been a few days and we haven't returned it. So, okay, guys, have a great day, night, afternoon, wherever you're at. We'll talk to you guys later. Thank you.